that's meeting the requirements. The one potential issue is that I brought up on the previous slide is the ability to evict a tenant because your income limits are too high. And where this comes into a problem is if you involve with other, we'll say, tax credit programs or governmental programs where income is an issue. And in one case I could think off the top of my head, which I have on the slide here, is the pilot program or a 121A agreement here in Massachusetts. Potentially that if your income is, or I say other states, if you have tenants that are more than the affordable range, then you cannot evict them for low-income housing for the extended use agreement. But the pilot program, you may not be able to take advantage of that program, which is a reduction in real estate taxes. And oddly enough, before we get into this next slide here, just to recap that is a problem where we think the IRS should address in their audit guide. I believe some commentary from various people have gone to them explaining that that extended use agreement clause or evicting somebody without good cause is an issue, and that they really should focus in on, what's policy? Policy is if we have a shortage of affordable units and you have tenants in the building, we'll say, that are out of the income limits, that are no longer their income limits are no longer an affordable range, then maybe they should be evicted. They signed an agreement that said, my income is X, Y, Z, and I should not be. I qualify for that unit, and then if they're 6 months later and no longer, they're more than 80%, we'll say, the average mean,